Assalamualaikum warahmatullahi wabarakatuh. Very good morning to everyone. Yes, all right. Okay, so let me see whether it is already recorded. So I will just share my screen. Okay, just to check with you what we did last week. I'm not sure where we were, but we were discussing on the present value, isn't it? Have we gone through the Excel worksheet? Did I use Excel worksheet last week?
No.
No, Prof.
All right. Okay. Let's quickly go to the Excel worksheet. Basically, you can use Excel to help you prepare this financial projection very conveniently. So this is we normally do this in the project evaluation or in capital budgeting. Essentially, project evaluation and capital budgeting are normally the same exercise. Essentially, where you will use the analysis to determine whether a particular project is worth implementing. So normally, when you prepare your project evaluation, you will start with the some assumption, and assumptions are essentially the basis of your projection. For example, you need to put in there the total initial investment. Okay, initial investment here can be at one lump sum, or can be year to year. Let's say we will have it year to year, and put in the amount. Let's say let me this is in thousand. And okay, then you will have the say you will have the yes, maintenance and upkeep. Let's say this is annual. Then you have the revenue stream per annum. This one is also uh, by year, and it may be different yearly.
My so my students are okay. So actually, I'm also the I never like yeah, yeah, I already yeah, from I'm from public prospect.
Ada lagi kot. Apa ni dia tak ada ya? Saya dah keluar pasal ada kelas.
But I did in Malaysia for 8 years.
Okay.
Your PhD in there? My PhD at USM. I see. And after that, okay. I have graduated on graduate for PhD. Yeah. Okay. Under my probation, one event, one Iraq. Apa sir? Ya, ya. Hari Ahad sibuk kan tu kan? Kita ada program tinggi. Orang Malaysia or Singapore? Program 40. That's why I'm just.
Right. Okay. um, um, so let's say this is right. Maybe I change a little bit here, otherwise it may not be balanced. Okay. Okay, and then so we have the initial investment, we have the annual maintenance, right? Then we need to specify the cost of capital. Let's say it's 12%. Actually, we can program this so that later on we will just input this directly, and we can relate with our financial projection. what else we need to assume? Let's work on that first. Yeah. So now we will prepare the financial projection. As we discussed last week, the financial projection will be year by year. So we will start with year 0, year 1, 2, 3, 4, 5, 6. We will limit to 5 years first. Later on, we can expand, but 5 years because we just want to show the concept. And then we start with the cash inflow. Then we have the cash outflow. So this is actually cash flow projection, and the cash inflow is from the revenue, and the cash outflow is from the capital outlay or investment, and the maintenance. So we have then the total cash inflow and the total cash outflow. Okay. So the investment, in this case, normally the investment will begin in year 0. I will change here, year 0. Basically, year 0 is today, now, and year 1 is next year. So this is the capital outlay, year 0. So the capital outlay here, what you need to do is just copy that from the box that we created here, and by doing this, you can always change the capital outlay later on, and you will immediately get your answer. The maintenance, maybe I suggest you mute.
Excuse me, can you guys mute the...
And then the cash inflow. Right. Okay. That's it. So this is 0. This is also 500. Now we total cash inflow and total cash outflow. For maintenance will start in year one, so in year zero is right. So we have the financial projection now. Let me make it bigger. And then you will have your net cash inflow, which is in this case is I want this to be showing negative because it is an investment. So all here sorry. So what we do is we will this is inflow minus right. Right, and then we may have another one here total. I will copy from here and right. Okay, so this project has a net cash inflow of 3.5 million only. Maybe from the onset we can tell that this is not viable. Why? Because the net cash inflow is too small. So what we can do, because this is financial projection, we can always change the assumption. For example, we can increase the revenue stream. Now it looks better. Okay, now the next one is we want to do the discount. Yeah, so this is the discount factor, and the discount factor is based on the cost of capital of 12%, and the formula is 1 divide by 1 plus R. Okay. So the I do not know why it doesn't like me to use the capital R. We will use the small r is the more appropriate. All right. So actually, for year 0, we will just use the discount factor of 1, because year 0 is now. Now, 1 ringgit is worth 1 ringgit. So the discount factor is 1. And then beginning in year 1, then only we use the discount factor 1 plus R. Make a mistake again. It's 1 divide. Okay. So actually, R here is is there, right? Then for year 2 is 1 divided by 1 plus 1 plus right. Okay. For year 3, it's 1 divided by 1 plus 1 plus 1 plus right. Yes. I actually in the program in Excel program, I should actually use the asterisk. Yes, something wrong there because of 1. Right. Okay, and then year 5. So depending on how many years you will have in your projection. All right. So we have here the discount rate for 5 years, and then we will just multiply down. Tujuh 11,5 ke? And then we have the sum. Yes. The sum here is so we see that the project A has we can calculate here the net present value by taking the I think here we will just to calculate the total present value. Is total present value is 1, and the total actually the total present value is this is the net present value, yeah, already, because we have deducted the capital outlay. If we because the capital outlay is in installment, so we if we want to discount just the cash inflow, we can also do that. For example, here just now we actually calculated the net present value. This is the net present value is if we want to do that analysis, we want to know what is the present value of revenue. Then we can actually calculate that as the total revenue here multiply by the rate, and we can just copy, so we get the and we get the total present value. Then we also do the present value of outlay, the capital outlay, which is actually we need a space here. Let's insert column. All right. So the present value of outlay is 2000 multiplied by 1. We copy. The total. And so our net present value is why is it different? Um, yeah. This is the something wrong. Something wrong with our model. This is this is the present value of revenue. All right. Present value of outlay. Present value of outlay. Actually, there is a maintenance cost that we have not taken into account. So we need to have the 500 here that is not taken into account. So our present value here is overstated. Overstated by the so we need to take into account here present value of maintenance, which is right. So that's the we can have here the present value of cash inflow from operation. So we will just put present value of operational cash inflow. Maybe we will make another insert. Right. So this is okay. Now right. So we got the answer. Okay. So after we have our net present value, we can assess the project based on other method. So project evaluation using other method, and we will start with the accounting rate of return, ARR. An accounting rate of return, ARR, is actually net profit after tax divided by total average investment. So in this case, the profit after tax, we did not take into account tax, but we have our so our net, sorry, net profit
Biar dapat malam tu.
operating profit, and our operating profit is the revenue we need to so our revenue, this is not discounted, we will take the undiscounted figure. What happened? Right. Hmm. The maintenance cost. Any question or comment? So this is profit before tax. And less taxation. Let's say taxation at 24% in Malaysia. So it is so profit after tax. Okay. So we will calculate the average investment. And average investment is 2 million here. And it is 3 million plus 2 million divided by 2. It is 7 million plus 3 million plus 2 million divided by 2. It is 8 million plus 7 million plus 3 million plus what's that? Yeah, something wrong there. It is 8 million plus 7 million plus 3 million plus 2 million and this is 6 million plus we are taking the average investment, so we need to take into account all the investment so far, and we divide by 2 to get the average. Right. Okay, and in year, there's no investment in year 5, so we will use the figure for year 4. Right, so the formula here, net profit after tax divide average investment. This is in percentage. Right. So that's the accounting rate of return. Accounting rate of return is high, but declining because of the amount of investment that we make. Next, we go for the payback period. And payback period is the number of years it takes to get back the total investment. But here the process is a bit complicated because payback period is normally applied for an investment project that involves a one lump sum capital outlay or capital investment in year 0. Then we will calculate how long it will take to recover the initial investment. So this may be difficult to apply in our case because the capital investment continue until year 4. So naturally, because this is a 5 years project, the payback period is in year 5 when we end the investment. But I mean, for our exercise, we can calculate this by taking year by year, for example, by taking what is called as the accumulated cash flow balance. So here we start with the capital outlay of 2 million. So there's 2 million there. Then in the first year, we have we calculated just now the net cash inflow. This is the net cash inflow for net cash inflow for year 1. So I'm not sure what I was doing just now, but let me go back and correct perhaps. So we have here net cash inflow in year 1. Okay, minus the cash outflow in year 0. This is because we have the negative figure just now, so it become positive when you minus. We'll do again. It is supposed to be net cash inflow minus. We want a positive figure there so that it will show the net negative. And then in year 3, the net cash outflow minus I don't know what happened. In year 3, minus right. In year 4, yes. Net cash outflow minus something is not right. So here, I guess we will just have to add all. Let's start again. Put this year 2. So we take total cash outflow Ah, okay. 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 So based on this accumulated cash balance, actually, from year 1, we already have a positive accumulated cash flow balance. So it reflects that actually we were able to recover the investment from year 1. So only in year 0 that we have to put in the 2 million. So that's a payback period. Next, we will look at the net present value, which we did just now. present value. So we will show the calculation here. This is the calculation that we want to show, the net present value. The formula will not run. Yeah, this. So we need just to copy back present value of revenue. Okay, and the present value of maintenance. Present value of capital outlay. Okay. So that's our net present value. Next analysis is the profitability index. And profitability index, PI. This is index is the present value of operating outlay divided by, let me write this, present value of cash inflow divided by the total capital outlay. So this is divided by total capital outlay is total investment, this is capital outlay 24 million. Present value of capital outlay. This is 24 million is if we take capital outlay at nominal value without present value. So we can have another one. If we take into account the present value of capital outlay, so we get the answer no, sorry, sorry, I made a mistake. This should be the present value of capital outlay. This should be the same. So answer here is 1.05. Here is why we are using two calculation is here is based on capital outlay in nominal. This is capital outlay discounted. We have to use this because this project has an installment investment. In most projects, you will incur the capital outlay or capital investment in year zero on the onset, but in this case, the capital investment is over the period, so that is why we have a different figure. But whichever figure you use, we see here that the profitability index is above 1. When it is above 1, that means the project is viable. In the case of net present value, as long as the let me write somewhere there. In the case of net present value here, the project is giving 5.322,150 excess return over the required rate of 12%. 12% is the cost of capital. In this case, also, you will write that the project has profitability index of over 1, indicating that it is viable. On the accounting rate of return, we say that the project has large accounting rate of return of between 44% to 152%. Per annum. Okay, so the payback period we say the payback period of the project is about is actually about 100. Now finally we want to calculate the internal rate of return. Internal rate of return is also called the IRR. So internal rate of return is the actual return of the project. So if we know the actual return of the project, we are not relying so much on the cost of capital, because right now the 12% that we use are based on the cost of capital, but we want to know the actual rate of return of the project, and this is quite tricky. IRR can only be calculated by using iteration method, i.e. by varying the discount rate so that we will achieve the zero net present value. So what we do here is we go back to our assumption and we now change our cost of capital here from 12% to another percentage, so that we will have the net present value here equals to 0. Since the net present value here is positive, since this is positive, so we know that the IRR must be higher than 12%. If this is negative, then we know that the IRR is lower than 12%, because we are using 12% to discount the figure. So let's put in at we start with 15%. So we change to 15, and we see what happens to the net present value. Net present value is still 4.6 million. That means it is much higher than 15%. Let's do 25%. At 25%, so now our net present value is 2.9 million. It's still positive. So it is higher than 25%. Let's do 35%. At 35%, now our net present value is still positive, 1.7 million. So we will change to 45%. At 45% is still positive, 1057. So it is higher than 45%. So let's do 55%. At 55%, it is still positive, 541. So it is higher than 55%. Let's do 60%. At 60% is, yeah, 60% is still 341. So it is still higher than 60%. 65%, 170. This project is quite peculiar because the capital outlay is also done in installment. So when the capital outlay is done in installment over 4 years, actually over 5 years from year 0. So whenever we increase the discount rate, the capital outlay will also be discounted. So all the investment in the later year will also be reduced in that sense. So this project is having a very good return because of that. Now is 23, so almost there. Almost there, but we already achieved 70%. So let's put it at 73%. 73%, then we have a negative return. So now we know that it is slightly lower than 73. We could change to 72 and still negative. So it is less than 72%. So it is 71. At 71, 3.66. So it's almost there. It's actually we can 70.5. We need to at 70.5 is 9.75. It is higher than that. Higher than that. So we can put 70.7. Is still higher than that. 70.8. This is the iteration process that we meant just now, yeah. 1.68. Yeah, it is slightly higher than that. So it can be a 0.2. Yes, it's still higher than that. Um, 0.4. Almost, we can have uh, almost. Now it's 0.48. 0.848 means is less than less than 1,000. So it is we can increase further. Higher than that. We can yes, still a bit higher. So maybe it is 0.35. A little bit more. This iteration process needs to be done using Excel like this. If it is done manually, it will take years, and you will get tired of them. Yes, almost. I think it is right. 0.08. We can stop here, or we can go on until we get the zero figure. Now it's a negative, so it is slightly lower than that. So this can be 4, 0.03, 4, maybe 3.7. Yes, almost. So it is um, 3.7 just now was negative, so it is lower than that. And so it could be 3.5. Yes, 3.5, lower than that. 3.4. Uh, 3. Uh, 0. Yes. So now it is perfectly 0. So when we it is perfectly 0, then we have the cost of capital there, which is the IRR. So you can then write there the IRR. So the internal rate of return is at okay. So we are done with this capital investment decision. Any questions or comment? Any question or comment? So in the capital investment decision, you need to calculate first the accounting rate of return, then you calculate the payback period, then the net present value, the profitability index, and the internal rate of return. The internal rate of return is the ultimate because this is the actual return of the project. And actually it is exceptional to get a return of 70%. But this happened because the capital outlay or the investment was spread over the years. The longer you delay the investment, the better effect you will have on your return or IRR. All right, let me save this and pass to you. This is the I will also pass to you a PowerPoint presentation on the capital investment decision, which you can go through yourself because it is a repeat of what we have been discussing last week and this week. So it is something that you can refer. We want to move to new topic. Okay. essentially the capital investment decision slide shows the process of investment, and we don't want to repeat that because we have many other topics to cover. We now will look at so we have covered capital budgeting. Now we will cover cost of capital. We have covered actually cost of capital indirectly when we calculate the cost of capital for the project. This is the notes from your module. If you go to your module, you can see this. And as we discussed earlier, company will raise fund, and they will raise fund for the activities that they will do, and that includes investment, and this fund can come from their own capital, from borrowings, from other form of investment that we will discuss. And these sources are referred to as the components of capital. It is also important to note that different components of capital or sources of fund have different costs. Each of these has a different cost because the actual cost of raising it and maintaining it is different. A company or a business can consider investing in particular which is expected to give higher return compare with the costs associated. So always the challenge in business is to earn more money from the fund that they raise. So they must be able to raise fund at a cheaper cost so that they can use the money to invest in a project that will give them a higher return. So if the return on their investment is higher than their cost of capital, then they will be making profit. It is essential, therefore, to bear in mind that the least return from an investment should always be equal to the cost of fund. So at least when you invest, you must make sure that the expected return is equal to your cost. But if you do that, means that you are not making any profit. Of course, most businessmen, company will still invest in project where they do not make a short-term return, but they are hoping that the asset that they bought will give some form of what is called as the long-term return, long-term return on capital, which is termed as the it is termed as the cap the we have the two form of return. One is called the operating return or the operating profit, and the other one is the capital gain. And the difference is capital gain will come from the appreciation of the asset, whereas the operating income come from the cash inflow and the cash and from the net cash inflow of the investment. It is always essential for a business to determine the viability of a particular investment that they want to undertake. Okay, cost of capital refers to the needed return, which is vital and needful in making a capital budget project, and it is the cost of a company's fund. Different people have had different definitions of the cost of capital. For example, Kion noted that the cost of capital refers to the minimum return rate that is needful to interest and fascinate an investors to hold or purchase a particular security. According to Spencer, the cost of capital refers to the least rate required rate of return, which is which a business need as the primary condition for it to venture into a particular investment. Gitman said that the cost of capital refers to the return rate that a business must accumulate from its project, considering that the market value remains the same. As Tresha and all define the cost of capital as the least needed return rate of earning or the cut off rate of the expenses. So, cost of capital is always the minimum return rate that business should gain from a particular project. And this is because business does not want to the par value of the business shareholders' equity to go down. And as we discussed earlier, that in corporate finance, the task or the challenge of management is to enhance the market capitalization or the net worth of the investor. So their job is to maximize the net worth of the investors. And to maximize the net worth of the investor, they need to maximize the share price. And to maximize the share price, they need to maximize the profit. So when they maximize the profit in the business, the profit will be reflected as earning per share. Earning per share will then determine the share price, as we discussed earlier that let me just jot down something on my whiteboard. So we say that the task of manager is to enhance the wealth of the shareholders. So the ultimate objective is to maximize the wealth of the shareholders. Okay, the shareholders' wealth is maximized through the maximization of the market capitalization of the company, and market capitalization is equals to share price multiplied by number of shares outstanding, and share price is determined by profit performance and the expectation of the market. So share price is equal to earning per share multiplied by price ratio. Earning per share EPS is really profit per share or net profit after tax divided by the number of shares outstanding. So the higher the profit, the higher will be the share price. Share price is also determined by the earnings multiple of the company or the profit. And profit multiple is reflecting the confidence of the investor in the ability of the company to generate higher profit in the future. PER of 20, for example, reflects that the investors in the market expect the company to continue generating profit at the same rate or higher in the next 20 years. So that is why they are willing to discount it at the price earning ratio of 20. To generate profit, a company must always involve in a project that will generate profit at higher than its cost of capital. The profit is actually the premium or excess of return over the cost of capital. So, if the cost of capital is at 12%, then the company must strive to generate return much higher than 12% per annum. Say 15 or 20% per annum. So just now when we calculate the IRR and the actual return of an investment by a company is the IRR. So, for example, if the IRR is 70%, it means that the company is generating a return of 75% per annum, higher than the cost of capital, 12% per annum. Of course, this is an exceptional case. Yeah? This is an exceptional case, but it happens. It happens if, for example, the project that they involve fit into this, for example, a project like building a ship. I mean, what Bastard was doing, building a fighter ship is is a long-term project. It takes 7 to 8 years, and the capital investment is done in installment because the parts will be ordered, but will only be received in installment over the future. So the payment will also be in the future, and they should be generating higher profit like that. Okay, so this is the model. So we can see that the model is always boiled down to the cost of capital. So we need to control our cost of capital, so that because this is what will determine the rest. And then from the cost of capital, we will then determine what is the return on the project or on the investment. And the return on the investment will be reflected in the earning per share. And earning per share will determine the share price, and share price will determine the market capitalization. Market capitalization will determine the shareholders' wealth. Okay, so it is like a scheme. Any question, comment?
So far, no, Prof.
Right. Um, So let's go back to the cost of capital. How do we determine the cost of capital? Cost of capital involves both the debt and equity. Debt is borrowing, and equity is the investment by the shareholder. And it is vital to note that the cost of capital stand in for the out of rate that the company must conquer and overwhelm before it can generate value. Cost of capital also referred to as the standard rate, the break-even rate, or the hurdle rate, or the minimum rate. Cost of capital is key in capital budgeting because it is used to ascertain if a firm should undertake a particular investment or not. Always, the rule of thumb is every investment must only be made if the return or the rate or IRR, the rate internal rate of return is higher than the cost of capital. So the cost of capital is used in accounting and economics to work out of the opportunity costs regarding a particular investment. It is also used to maximize particular investment in the process. And the cost of capital comprise three components, which include common share or common stock, preferred stock or preferred share, and debt. So the cost of capital is used to ascertain the current value of the return, and the cost of capital is determined to evaluate a particular project. Most importantly, cost of capital is used in companies or other firms to make different financing or investment decisions. How do we calculate the cost of debt? Cost of debt is the effective interest rate in which a firm pays for its debt. And debt costs may involve things such as loan, bond, or sukuk. Sukuk is the Islamic version of bond and other liabilities. And cost of debt is also cost of a particular debt before tax. We use before tax because debt has a peculiar thing. When we borrow from the bank or any institution and we pay interest, the inland revenue rule is to allow this interest expense to be deducted as an expense, which mean that actually sorry which mean that the debt cost is being subsidized by the inland revenue in calculating the tax. Unlike share, if we invest in share, if we use equity financing, that means we raise capital to start a project. The cost of dividend that we pay to the shareholders every year is not tax deductible. Yeah. I repeat again, the interest that we pay the bank or the lenders when we borrow is regarded as an expense for tax purposes, and hence it will reduce our tax liability. And when tax liability is reduced, we will have more net profit after tax. It has this unfair treatment on debts, and that is why we use profit before tax. If we use we use debt before tax. If we use debt after tax, we will see that the cost of debt is much lower. Cost of debt can also refer to the return that a business or a firm gives to its creditors or debtors holder. It is essential to bear in mind that the difference in the cost of debt before and after tax depend on the fact that tax deductible is the interest expense. Rates of interest for the borrowed capital quantify the return rate. The cost of capital form as part of the company's capital structure. Cost of capital comprise of the cost of equity, which refer to the rate of return that the company must pay the equity shareholders or the owner in the form of dividend. On the other hand, capital structure involve how a business fund its growth and daily operation. It is easier to work out the cost of capital than to work out the cost of equity. So cost of debt can be worked out using two methods. One is called the yield to maturity, YTM, and one of the methods to work out the cost of debt is by determining the yield to maturity of a company debt. Yield to maturity refer to the annual return from a project acquired today and held until maturity. The current yield to maturity is determined, and the year to maturity will ascertain the yield on the bond with regards to its current price at the bank. It is used when the firm being analyzed has a simple capital structure. So in developed nation like US, Europe, bond is a common instrument used for debt financing, where a company can actually issue bond and offer that to investors to subscribe. So investors will actually be buying this bond as an investment and keep this as their asset. The attractive of bond is that it gives a fixed return every year, regardless of what is the situation in the market. So the bondholder will receive return based on the face value of the bond. In the bond certificate, the rate of return are specified. Rate of return are specified. So bondholders are felt that it is safe to invest in bond because the companies are large company that are established, and companies are unlikely not to honor the bond because they are large company. But in Malaysia, we do not see much of this bond financing being used because Malaysian companies are not regarded as an established company. And to actually issue a bond, a company must be properly rated by the rating agency, which is an independent company that will do the rating of the company. And based on the rating, the company will recommend the interest rate on the bond. The less reputable the company, the higher will be the rate of return on the bond or the interest rate on the bond. And so in the US and Europe, for example, you may see some bond which are considered as a junk bond. Junk bonds are that are issued by company that are not very established. So the interest rate is normally very high to attract investors to invest. But the junk bond has a big risk because if the company go down, then you will lose your investment. Any question or comment? Yes? Question? So in Malaysia, we have established sukuk, and sukuk is the Islamic versions of bond, and normally sukuks are issued by government, mostly the government agency. So it is more established. But there are also some big company that issue sukuk, and sukuk will be subscribed by international investor. All right. That's so this is the calculations of the or the formula for the year to maturity cost of bond. It is the coupon rate. Coupon rate is C. C here is the coupon rate as stated on the bond certificate, and F is the face value. Yes, F is the face value of the bond, and P is the price that the company is selling the bond. Normally, the company will sell the bond at a discount. Let's say if the face value of the bond is 1 million, they may sell it at 980, giving 20 as a form of discount. So that is why you have the face value, which is the stated value on the bond certificate, differ from the price. So we will calculate the year to maturity costs as the you see the difference between the face value and the price plus the coupon rate or the interest rate. The second method is called the debt rating, and in this approach, debt cost is with regards to the company debt rating, and it is used to cases where current market price data for its market data for its debt is not available. So debt rating approach will use return on relatively rated bond with maturities that are in line with the maturities of the form of existing debt. And this is the example. For example, so imagine that firm A has a senior secured debt which has an average maturity of 5 years. The maturity is 5 years, and the firm marginal rate of tax is 20%. Suppose the firm's debt rating is triple B minus, and the return on similar senior debt, which is unsecured and has the same debt rating, but the maturity is 8%. Therefore, the firm after tax cost of debt will be 1 minus T. 1 minus T is because of the tax rate. The tax rate, this is profit before tax actually. And this is equal to 8%, which is the debt rate multiplied by 10 minus 0.2, the marginal tax rate of 20%, which is equal to 6.4%. So taking into account the tax rate at 20%, the cost of debt, which is 8%, is only 6.4%. So the cost of debt is significant in various ways, because the cost of debt will help to understand the interest rate by the firm as it uses various types of debt financing. And the cost of debt can also provide investors with insight into a firm levels of risk. This is important to as risk-averse investor can use to the level of to determine the level of risk between the various countries. And the cost of debt can also be used by companies and firms owners to determine how external finance have an impact on the business. And cost of debt is useful for lender and partners to ascertain the financial health of a firm. Okay. Cost of capital can be improved by the firm and to ensure that they practice refinancing. And refinancing refer to the process of replacing the existing mortgage or loan to a new loan when the interest rate can come down. Especially today, if you buy sukuk, on the sukuk certificate is actually mentioned the rate of profit, and the rate of profit is determined by the current interest rate. So at the time when the interest rate is high, the mortgage or the sukuk will have higher cost or the interest rate. But when the OPR in the market come down, then company will be able to issue a new sukuk at a lower price, because the price always refer to the OPR. So during the low interest rate, companies should refinance their debt. And how do they refinance? Is by issuing new sukuk and raise money enough to pay the old loan, so that they will overall pay a lower financing costs on the debt. Right. Then, so we have discussed bond and sukuk or debt financing. Now we will look at another form of financing, which is preference capital. preference capital, which is actually from preference shares. And what is preference shares? Preference capital refer to the part of the capital that is usually raised by a firm through the issuance of preference shares. And preference capital is usually referred to as a hybrid instrument. It is hybrid because on the one hand, it has a debt element, where the debt element is the fixed return rate or the interest rate. But at the same time, it is called a share. So it is part of equity. So preference share is a hybrid instrument that is both a debt and equity. It is a debt because it has a fixed rate of return, but it is not fully debt because if a company is not making any profit, then the company is not obliged to pay dividend on the preference shares in the same year. So the company can postpone payment of this return to the preference shareholders by having what is termed as the cumulative preference shares. So when you have a cumulative preference shares, the dividend can be cumulated to the future year. So the company will only pay dividend in the later year when they make profit. But the preference shareholders have a higher preference than the ordinary shareholders to get dividend. So if in the future year, the company makes some limited profit, then they have the obligations to pay dividend to the preference shareholder first. And that is why it is called the preference share. So the preference shareholders will receive their dividend first, and if there is any leftover, then the balance can be used to pay dividend to the ordinary shareholders. Yeah? And it is called an equity because it is called share, but the preference shareholders do not have votes in the annual general meeting. So they can come to the annual general meeting to enjoy their foods, but they cannot vote. Only the ordinary shareholders have the right to vote in the annual general meeting of the company. And this is normally the votes to determine the dividend rate, the appointments of new directors, the approving the budget, and so on. Right. It is essential to note that the preference shares are divided into 4 categories. One is called the cumulative preference shares, and cumulative preference share is where the dividend can be accumulated to the future year. There are some preference shares that do not have the cumulative features, which means that if a company do not have enough profit to pay dividend, then they will just forgone the dividend to the preference shareholders. So this is the non-cumulative preference shares. The non-cumulative preference shares is where the dividend will be omitted if the company do not make any profit. Next is the participating preference shares. This is the participating shares always pay the shareholders additional dividend on top of the preference dividend. If the company doing so well, then there is an extra dividend that will be paid to the participating preference shareholders. So this gives them the more incentive to invest in the preference shares. And next is the convertible preference shares. And this is a preference shares that can be converted into common share at a particular rate. This is to also give an incentive. On the one hand, the preference shareholders want some security that they will have return, so they may be subscribing to cumulative preferences. But the cumulative preferences may also have this feature of convertible. So it is called cumulative convertible preference shares, where after certain time, when the preference shareholders are more comfortable, more confident of the company, they will convert their preference shares to the ordinary shares. The advantage of converting to ordinary share is that number one, the shares are listed, so the price will reflect the performance of the company, and also the shareholders can vote in the annual general meeting. Some advantage and disadvantage of these preference shares, the different types of preference shares. Right. So we have covered that. We have covered the preference shares. Now the next one is called the equity capital and retained earnings. There is two portions here. One is the equity capital, which is the common shareholders or the ordinary share. These are the initial contribution, the initial contributions of the shareholders in the company in the form of shares. Then the company making profit, and as the companies are making profit, as the companies are making profit, they may use some of the profit to pay dividend, but they may use the excess for reinvestment. And when they use the excess profit for reinvestment, this is called retained earning. And retained earning has a cost because the opportunity cost of retained earning is at least the dividend rate. So the concept of owner's equity and retained earning are used to represent ownership of a business and can relate to different form of businesses. And owner equities is a category of account that represent the business owner's shares of the company, and retained earning applies to the corporation profit reinvested. Equity capital. Equity capital refer to the fund the investor pay to the company or businesses to acquire either preference or ordinary or common share. In most cases, this is the main source of company's capital. Equity capital is capital raised for exchange of partial or full ownership of the company or the business. An investor provide equity capital to firm for various reasons, and in most cases, the firm will always issue dividend to the shareholders. The share of the share of the company may appreciate, an investor can sell the share or at the profit. In cases where the investors own a number of shares of the firm, he or she might have increased control over the operation of the company. And having control of the company is very important in business because a lot of the time you only have to own 30% share in the company to have the control of the company. And when you have control of the company, you have the right to actually determine the senior management team in the company as well as the board of directors. So you have a privilege in running the company. Retained earnings. Retained earnings refer to the amount of income that remains in the company or firm after the dividend has been paid to the shareholders. And a firm can have negative or positive retained earning. If it is negative, it is called the accumulated deficit. The negative retained earning refer to the losses made by the firm, while positive retained earning refer to the profit made by the firm. In most cases, the positive retained earnings are invested back to the firm or company to ensure its growth. There is a specific formula for calculating retained earnings cost. So this is the formula. Retained earning is equals to beginning period retained earnings plus net income minus cash dividend minus share dividend. Share dividend is also called the bonus issue, where a company issue bonus to the shareholders in the form of shares. So this is the formula that you need to use to calculate the retained earnings. It can be noted that the long-term shareholders of a particular particular usually expect to be rewarded by company regularly. So if the company make profit often, and they expect this because they provided the firm with the equity capital, and the company management decide on how to divide the retained earning among the various classes of shareholders of the firm, and they decide what money to be left for the operation of the company. So it is important to note that the retained earning can have various uses. This include the retained earning to be used for share buyback, where the firm can purchase its own share. So what is share buyback? If a company, for example, is listed on the Bursa Malaysia or Stock Exchange, and they saw that the share price has gone down drastically, and that make it cheaper for them to actually buy the share. But the company was the one actually issuing share for the market. and it is being traded in the market. And now the share price has gone down, and the company can decide to reduce the number of shares outstanding in the market. And to reduce the number of shares outstanding, the company can buy some share from the market at market price, and then after they collected back all the shares, they will actually cancel the shares. And what is the advantage of doing that? Is when you cancel the certain number of shares that you have issued before, that will reduce the number of shares outstanding, and that will increase the earning per share, because earning per share is calculated based on the net profit after tax divided by the number of shares. So when you increase the earning per share, the share price will also be increased. So when the share price increase, then the shareholders, the remainder of the remainder of the shareholders will be enjoying the share price increase. So that's the purpose of share buyback. Share buyback is not very popular in Malaysia, but it is popular in the US, and normally is being capitalized during recession. During recession, when the share price came down drastically, the company will use every opportunity using the cash that they have in hand to buy back the share and reduce the number of shares outstanding. Question, comment? The firm can also use retained earnings to invest in a new project, like launching a new product. I mean, of course, the objective of a company is always to enhance the overall rate of return, because they want to make sure that the rate of return on their project or their performance overall is higher than the cost of capital. Otherwise, the company's share price will decline. Number 3, retained earning can also be used to expand business operations, such as increasing the productivity of the firm. This is to increase the profit, and when the profit goes up, the earning per share goes up, then the share price will also go up. Retained earning can be used in acquisition, mergers, or partnership with other firms to improve production in the market. In the assignment, I've given you a case of merger between Sunway Construction and the Sunway Holding, and they are both companies in the same group, but they were two different entity listed on Bursa Malaysia. So they performed the merger exercise in 2011, and we see some of the result in the mergers, the immediate result and the result after that. But there has been many research that prove that overall, in the long term, mergers or acquisition does not produce the required or the expected objective, essentially because mergers are seen as as a way to manipulate the market. But you can, in that Simon, you can deliberate. It is a project paper. It is a group assignment where you can find the latest data on the performance of Sunway Group and determine whether the mergers 12 years ago has actually make the shareholders of both company better off. Yes, so this is a mergers. And mergers is always very costly because you have to pay the merchant bank to be the advisor, to be the coordinator, and you have to pay double. You have to pay for both companies that are being merged. And return earning can also be divided among the firm shareholders in the form of dividend. Right. So now we have the cost of fund from the debt, from the preference share, and also from the equity, the common share, and the accumulated profit or return earning. So we now try to combine all these costs and work on the weighted average cost of capital. The combined cost of capital is reflected by the weighted average cost of capital, which refers to the working out of a company costs of capital, where each class of capital is weighted. So all the firm source of funds are included in the calculation, and the sources of capital included a bond, common share, common stock, or common stock or common share, sukuk, long-term debt, preference share. And it is essential to note that weighted average cost of capital of a company will always increase in cases where beta and rate of returns on equity also increase. So this is so because the increase in the weighted average cost of capital indicate an increase in risk and a reduction in valuation. So this is the formula for the weighted average cost of capital, but actually I have shown you last week on how to calculate this weighted average cost of capital. If you refer back to your note, this is how it is calculated. You have the share capital, preference shares, bond, sukuk or instrument, bank loan, overdraft. So you determine the rate, the cost, yeah, and then the volume, and then you determine the annual cost of the capital, and you divide that by the total volume, and you get the weighted average cost of capital. So this is the actual calculation, and here you see the formula where E divided by V is the percentage of financing through equity. RE is the multiplied by the cost of equity. D divided by V is the percentage of financing through debt, multiplied by RD is the cost of debt, plus multiplied by 1 minus tax. So here the debt remember the debt cost must be after tax because debt is partly subsidized by the government through the tax reduction. Okay, the weighted average cost of capital is most of the time used in the discounted cash flow or the present value analysis as the discount rate for the future cash flow. And there are various advantages and disadvantages of this weighted average cost of capital. The advantage is that it is enable fast decision, and only a single hurdle rate is used for each project. But the disadvantage is it is complicated to use and calculate. The cost of equity may be varied for different reasons, hence reported differently. And investors cannot rely on it as it can give wrong information concerning the venture. I mean, this is debatable, but overall, the weighted average cost of capital is the best form of cost of capital. But in the end, as we discussed earlier, what matters is the IRR. So if as long as the IRR is above the weighted average cost of capital, then the project is viable. Cost of equity and the CAPM. CAPM is a capital asset pricing model, and it is essential to have in mind that CAPM can be utilized to work out the cost of equity, and CAPM referred to the capital asset pricing model. The formula determines the shareholders' equity cost. So CAPM has been used in calculating cost of capital to risky security and in determining the expected return for asset provided with the risk associated. And it is essential to bear in mind that to calculate CAPM, one must have the following price of information: the risk-free rate. Risk-free rate is the rate of return after taking into account risk. The return rate for the general market, and the value of beta of the stock in question if we are investing in the beta or in the stock um, um, listed share. So CAPM can be determined by this formula. The capital asset expected return, ERI, is equals to the risk-free rate of interest plus the sensitivity, which is the beta, minus the RF. So ERM is the expected return of the market. Okay, so in summary, cost of capital refer to the needed return, which is vital and needful in making a capital budget project. It is essential to bear in mind that the difference in the cost of debt before and after tax depend on the fact that the tax deductible is the interest expense. And the yield to maturity refer to the annual return from a project acquired today held until maturity. In debt rating approach, the cost of debt is with regards to the company rating. and the preference capital or preference shares refer to the part of capital that is usually raised by firm through the issuance of preference shares. Right. So that's the aspect of cost of capital. So we have covered now the cost of capital, and we will start a little bit on the leverage and financial leverage is another jargon that you need to learn. Financial leverage is an American term. Leverage comes from the word of lever, and in America, gear is called lever. So when you drive a car, you have 5 lever or 7 lever on 7 gears. Yeah? So leverage is the word to reflect lever. The leverage essentially mean how many times that you use borrowing compared to equity. In the English term, if you are more British, then we use the word gearing. It's from the word gear. We have 5 gears in the car, and we have gearing. And the principle is based on the principle of gear. We normally use the lower gear when we are on a low speed. When we are on the low speed, and we use a higher gear when we are on a higher speed. And when we are moving from a low speed to a higher speed, we should change our gear. We should change our gear because our gear will help lighten the energy that is needed to move forward at a faster rate. So that's the idea of leverage. The idea in leverage is that in our everyday financing, we must always try to maximize our borrowing, because borrowing cost is much cheaper than equity. Yeah, borrowing cost is much cheaper than equity. And we mentioned earlier, I think, that OPM, other people's money, is the best source of capital. So always, if we want to start a business, we must use other people's money because that is cheaper. Only when we cannot find other people's money to be confident enough to invest in our project that we will use our own capital. But that's the conventional perspective. The Islamic perspective is actually there is no such thing as borrowing in business. We need to use our own money in our business. So what if we don't have money? We will invite partners, and the partners will contribute capital, and they will become part owner of the business. Of course, this requires us to be more sincere in our business, because we are in business to together make profit. So when we invite another persons to become a partner, we must have in mind that we are willing to share the profit with our partners. So we have to reduce our greediness and so on. Right. This is financial leverage is also referred to as trading on equity as or a simple leverage. Trading on equity means we are using our equity to leverage. Any company or firms requires financial capital to operate its business, and most of the companies will increase their capital by disposing their common share and giving out debt security in stock market. It is important to note that the amounts of equity and debt make up a business capital structure. The amounts of equity and debt is associated with the many risks and return implications. The firm should use prudent strategy to establish its target capital structure, and the capital structure is the strategy or process where a firm or company will uses its fund to finance its operation and growth. Essentially, we need to structure our capital well so that we will use the combination of both the equity and borrowing optimally. A company's capital structure employ financial leverage to finance its operations, to ensure growth, and to receive huge return. And why borrowing is regarded as cheaper than capital is also because just now we mentioned that when we borrow, the cost of borrowing is tax deductible, which make it cheaper overall. Yeah. So the capital structure is the strategy or process where a firm or company use its fund to finance its operation and growth. A company capital structure employ financial leverage to finance operation to ensure that its growth and to receive huge return. So financial leverage refer to a strategy employed by firm and companies to increase return, cash flow, and asset. The strategy can magnify asset. So actually borrowing is a process of magnifying our capacity, and it can also refer to an investment strategy that a company or business firm uses its finance. Um, how do we measure leverage? Financial leverage is ascertained as a ratio of the total amounts of debt or total amounts of asset, and therefore it measures using the debt to equity ratio. It illustrates the percentage of debt to the firm's equity. So as a manager, we try to balance the proportions of our own share with the debt. And so this is the formula of our leverage actually is total debt divided by total shareholders fund. So we are relating between the debt and shareholders fund. So the total debt comprised of the long-term and short-term debt, including overdraft and bank loan, and the sensitivity in the fluctuation of this company's profitability to operating income volatility is caused by the change in the capital structure and measured by the financial ratio. So the degree of financial leverage will actually determine also our profitability. This method is used to quantify companies' financial risk, and it is worked out by the division of the percentage change in net income by the percentage change in profit before interest and tax, or EBIT. So the following formula is used to calculate the financial leverage. Degree of financial leverage is percentage change of net income over percentage change in earning before interest and tax, or profit before interest and tax. Right. We will continue next week, and we will use this degree of financial leverage to actually determine the effect of our strategy on profitability. Right. Thank you very much.
Prof,
Yes.
I have a question on the group assignment.
Yes.
Per group is how many percent?
Actually, ideally it should be 4%.
4%, yeah?
Yeah.
Okay. For the group assignment, okay. For the individual assignment,
Yes.
question number 3, after more than 13 years of merger. So
Yes.
this one, if we can get the data from the 2023, is it enough?
Yes. Yes.
Okay, yeah. Okay, that's all.
Right. Thank you.